My name is Farhan. In today's video, you will solve question number 4 from 2022 past exam. This question requires you to reconstruct the capital account and calculate the budgeted cash drawings. You're also required to prepare the financing activities section for the cash flow statement and find the net increase and decrease in the cash position from one year to the next. If you want any other topics to be covered, make sure to post them down in the comments below. Also, like this video and subscribe to this channel so you get notified when I drop videos every time. With that being said, let's get started. Wallace Shoes reports annually. The accountant is preparing the budgeted cash flow statement for the financial year ending 2023. The following information has been provided. So you can see that we are given the balance sheet extracts, the actual results at 30 June 2022, and the budgeted results for the next financial year ending 30 June 2023. We are also given the actual net profit for the year ended 30 June 2022 of $212,000 and the forecasted net profit for the next year ending 30 June 2023 of $170,000. We are given some additional information that we need to include in our workings. Our first requirement is to reconstruct the capital account to determine the budgeted cash drawings for the year ending 30 June 2023. Now, I need you to understand something before we start preparing the ledger account. So, any drawings that we make from our business, that is going to result in a reduction in the capital that we have in the business. So, capital by default is always credited. So, which means when capital increases, when we make capital contributions, we credit the capital account. But every time we're reducing the capital, and the only way we can reduce the capital from the business is by withdrawing the money or the profits or whatever we have within the business for reinvestment purposes. So when we make that withdrawal reflects a reduction in the equity that we have in our business and will therefore be debited, which is basically what we do for capital when it increases, and that is credited. So let's start with the reconstruction first, and you can see that the opening balance was already given to us during the exam, 1st July 2022, opening balance on the credit side being $320,000. So why is the opening balance on the credit side? This is because capital, as we have just discussed a while ago, by default is credited, which means when capital increases, we credit it. And when capital decreases, we debit it. Now, let's just assume the opening balance at 1st July 2022 was not given to us. All right, so let's just assume we were not given this directly here. Where would we look for this opening balance then? So let's scroll back up to the question, and you can see that the balance sheet extracts the actual results at 30 June 2022. You can see the capital under the owner's equity of $320,000. So this is the closing capital at 30 June 2022, which would be the opening capital in the next financial year starting 1 July 2022 and ending 30 June 2023. So this is where we would look for this amount. So 1st July opening balance of $320,000. Then the closing balance ending 30 June 2023 is $500,000, which is what we can find from the budgeted balance sheet extracts. And you can see the capital of $500,000 is what we expect at 30 June 2023. Now, excuse me. So on the credit side, you can see that we have added bank and vehicle. So this is referring to additional capital contributions. And any capital contribution that we make into the business increases the capital of the business. And when capital increases, we credit it. So that is why we're including these two lines here. But where do we get this information from? So let's check the additional information. And the second sentence, it says that in September 2022, the owner will contribute $40,000 cash and a vehicle with a fair value of $30,000. So $40,000 cash is referring to the owner injecting more money into the business. For example, the owner will use the personal bank account and transfer $40,000 from the personal bank account to the business transaction account. So what's happening here? The owner is injecting capital into the business, which is coming directly into the bank, and that refers to a reinvestment, which therefore increases the capital, and that is why it is included on the credit side of the capital ledger account and bank $40,000. Then we also know that the owner contributed a vehicle which has a fair value of $30,000. So fair value of $30,000 is what we will be recording this asset. So this asset is an investment into the business. And because this is an investment, it increases the capital, the owner's equity in the business. And when capital goes up, we credit it. And that is what's essentially happening here. Then we are including the profit and loss summary. And this $178,000, so where do we get this from? This is the forecasted net profit for the next financial year ending 30 June 2023. Whenever we have a net profit, it increases the owner's equity in the business. Net profit increases owner's equity, which means the capital increases. And because the capital is increasing, we are showing it on the credit side of the capital account, profit and loss summary of $178,000. Now you might wonder, why don't we write net profit instead of profit and loss summary? Always remember that you might have learned closing accounts by now. And in the closing accounts, we close all the revenue and all the expense accounts, right? And whatever net profit we get, we close that against the capital account, which refers to the profits being a reinvestment, being reinvested into the capital for the next financial year. So that is why we are including this on the credit side, just because this increases capital as well. So our main requirement from this question was to calculate this line, which I'm highlighting in yellow, the drawings of 68,000. So how do we find that amount? Let's assume we do not have this to begin with. So we take a quick glance within the capital account, and you can easily see that the credit side is the heaviest side. So we add all the lines here, which gives us a total of 568,000. That must be the total on the debit side to ensure the fundamental accounting rules apply. And once you subtract the closing balance of 500,000 for 30 June 2023, you're left with $68,000, which refers to the reduction in capital, and that can only happen through drawings. So the owner made some cash drawings from the business, and that was $68,000. So this is what we expect the owners to withdraw for the next financial year ending 30 June 2023. So the next requirement of the question is to prepare the financing activities section of the budgeted cash flow statement. So financing activities simply refers to the cash inflows and outflows in terms of capital contributions and adding loans or repaying loans within the business. So the first line that we're given here in the additional information says that a new loan for 60,000 will be taken out in August 2022. We know that the new period starts on 1st July 2022 and ends on 30 June 2023. So if we are taking out a loan in August 2022, it is falling during the new period, which is the next period, and that is what refers to a loan taken out, means the loan is invested into the business, although it is a liability, which means cash inflow. So whatever loan we have taken out, taken it out for the purpose of investing in our business, so injecting into the business. So that is why when we prepared the financing activities section, we have shown loan as positive plus 60,000, which refers to cash inflow. That is why we are showing it as a plus. Then, what about this line, capital being 40,000? So this capital of 40,000 here refers to the transaction in September 2022 when the owner contributed $40,000 in cash. So if the owner injected $40,000 in cash into the business, and given that the budgeted cash flow statement is from the perspective of the business, the business is getting money, which is the $40,000 in cash as capital to be invested within the business. And that is why, from the perspective of the business, this is a cash inflow, and that is why we are showing capital as plus 40,000 here. Then we'll talk about loan repayment. But before that, let's quickly finish the drawings. So the drawings of $68,000 negative, referring to an outflow, is obviously what we took from the reconstruction of the capital account, where we calculated the budgeted cash drawings of $68,000. So drawings refer to a reduction in owner's equity, and also because it is cash drawings, it's referring to an outflow. And the reduction in owner's equity is obviously going to have an impact on the financing activity, and therefore the drawings here is shown as a negative amount referring to a cash outflow. So what about the loan repayment of negative 15,000? So if you check the first additional information, it says that loan repayments will be made during the year, and interest on the loans for the year ending 30 June 2023 is expected to be $6,500. Now, loan repayment here refers to the repayment of the principal. The principal refers to the amount that we have borrowed. Interest is a cost of the loan that the business has to pay. Interest that we pay on loan is a separate thing to the principal. So interest that we pay on loan is not a financing activity. It is an operating activity because that is basically the cost of doing business. All right. And also, whoever you take a loan from, they do not own anything in the business. They're just a debt holder. So we see them on as something different. So that is why, based on Australian rules, interest paid on loan is always an operating activity. And the $6,500 that we're given here in this case is irrelevant for putting it into the financing activities section. But if you had the operating activity section, you would definitely include it there as an outflow because you're paying the interest of $6,500. But what about the loan repayments, the principal that we're referring to? How do we find out how much we have paid out for our loan? Very simple. So let's go to the balance sheet, and you can see that we got two types of loans, one under the current liabilities section and one under the non-current liabilities section. And the loans that we are given within the current liabilities section refers to the repayments that we will be making in the next 12 months. And that is the main reason behind classifying them as a current liability. The loans that we're given in the non-current liabilities, those refer to loan payments that we will be paying after the next 12 months. So that is why they fit the definition of a non-current liability. So let's find the change first under the current liability section. You can see that in between 2022 and 2023, the loan is increasing from 10,000 to 25,000. So that is why the change is plus 15,000 here. So if the change is plus 15,000, that means we have taken out more loans, which is referring to cash inflow. Okay, so hold that thought. So now let's move to the non-current liability section. You can see the loan from 30 June 2022, $30,000, that is increasing to $60,000 by the end of 30 June 2023. And this is referring to an increase of 30,000, so plus 30,000, more cash coming in. All right, so these two loans gives us 45,000 in total. And based on the additional information, we know that we have taken out 60,000, right, initially. And if we now have 45,000 at end of 30 June 2023, where did the other 15,000 go? So that is the repayment that we have to calculate. So we are including that loan repayment of 15,000. Why is it within a brackets or negative? This is because the repayment here refers to cash outflow. So you just add and subtract whatever is required, and then you get 70,000 positive, which refers to net cash flow from financing activities. All right, so that's all for part B. Now let's move to part C. So part C requires you to calculate the budgeted net increase or decrease in the cash position for the year ending 30 June 2023. Right. So if you check the balance sheet extracts for the financial year 30 June 2022, you can see that we had bank as current assets of $14,300. And if you check the balance sheet extracts, the budgeted extracts as of 30 June 2023, you can see that we do not have any money in the bank. That is why it's zero. But what happened is we now have borrowed 6,700 from the bank, which has resulted in our bank balance being minus 6,700. And how can we verify that? Because it explicitly mentions overdraft. So the actual bank balance as at 30 June 2022 was 40,300. We had that money in the bank account. That was a positive 40,300. But we are expecting as at 30 June 2023 to not have this money in the bank account and instead have a negative balance of minus 6,700, which is what we have taken from the bank, which means we have spent more than what we actually had in the bank account. So if you're running a business, you're allowed that in Australia. So on the right hand side, you can see that I've drawn a timeline here. So on 30 June 2022, you got 14,300, and on 30 June 2023, you got minus 6,700. So how do we go from 14,300 to minus 6,700? So what we are doing here is using an equation, simple algebra. So we start with 14,300 today, and we add x. So the x here refers to increase or a decrease in cash position. And that gives us minus 6,700 as the balance that we expect to have at the end of the next year. So what we do here is just simply do algebra. So if you want to solve for x, it's simply minus 6,700 minus 14,300, which gives you minus 21,000. So negative 21,000 refers to decrease of 21,000. So the question is asking, calculate the budgeted net increase or decrease in the cash position for the year ending 30 June 2023. So you have to explicitly mention in the exam that there is a decrease of $21,000 in the cash position. And that is how you get full marks in question 4. That's all for today's video. Make sure to like this video and subscribe to this channel, and I'll see you in the next lesson.